Hello friends, welcome to Learn Easy. We will discuss Capital Asset Pricing Model CAPM. The Capital Asset Pricing Model CAPM calculates the value of a security based on the expected return relative to the risk investors incur by investing in the security. The Capital Asset Pricing Model CAPM was developed by Sharpe, Lintner and Mossin. The purpose of CAPM is around the determination of an investment's appropriate required rate of return, taking into account systematic risk and the expected return from the market. The general expectation in a competitive market is that if securities and investments have the same level of risk, they should have a same level of expected return. Let us see the assumptions made in Capital Asset Pricing Model CAPM. First assumption, a risk-free rate exists in the market and investors can borrow and lend unlimited amounts at this rate. One request, if you are new to my channel, please subscribe, share and press the notification bell. Second assumption, the markets for risky assets are perfect, meaning investors have access to all the information that can affect the price of a given security. Third assumption, the investor has similar expectations of return as well as risk. This leads to investors of having homogeneity in the conception. Fourth assumption, investors are price takers whose individual buy and sell decisions do not affect the price. There are no transaction costs. Also, there are no taxes. There is the existence of perfect competition in the market. That is, free access to all information is available to all the investors. Seventh, all assets are marketable or liquid. That is, investors can transact in large quantities with little or no impact on the price. Eighth assumptions, investors make their investment decisions based on the complete assessment of risk and return. One request, if you are new to my channel, please subscribe, share and press the notification bell. Ninth assumption, investors' utility functions are based solely on the expected portfolio return and risk. Let us see the formula for CAPM. ERI is equal to RF plus beta I into ERM minus RF is equal to RF plus beta I into MRP, market risk premium. ERM minus RF is equal to MRP, where ERI expected return on the portfolio, RF is risk-free rate of return, beta I systematic risk of the security, ERM is expected return of the market, MRP is market risk premium. Let us see the key components of CAPM. Expected return on assets, ERI. The expected return on an asset, ERI, is the return that an investor anticipates receiving from an investment. This return reflects both the potential income from the investment, such as dividends or interest payments, and any change in the asset's price. Risk-free rate, RF. The risk-free rate is the minimum return an investor expects for an investment, as it is the return of the risk-free asset, typically a government bond. This rate serves as a benchmark for assessing potential investments, grounding the return expectations in a certain degree of reality. Beta I, measure of systematic risk. Beta I is a measure of an asset's systematic risk, or the risk that cannot be eliminated through diversification. It reflects the asset's sensitivity to market movements and is thus a key determinant of the asset's risks and return profile. Market risk premium (MRP). The market risk premium (MRP) is defined as the expected return from the market as a whole (ERM) minus the risk-free rate (RF). The market risk premium encapsulates the additional return an investor anticipates for taking on more risk by investing in the market instead of sticking to risk-free securities. Let us see the graphical representation of the components of the capital asset pricing model CAPM for a portfolio. Y-axis represents return, x-axis represents systematic risk beta. ERM is expected return of the market when beta is equal to 1. The point above security market line is a portfolio outperforming the market. The point below security market line is a portfolio underperforming the market. Let us conclude. The capital asset pricing model is a financial tool that calculates the value of a security based on the expected return relative to the risk investors incur by investing in the security. By incorporating the risk-free rate, market risk premium, beta, and expected return on assets, the model helps investors assess potential returns and understand the risks associated with various investment options. CAPM finds wide application in investment decision making, guiding the construction of efficient portfolios and optimizing capital structures for companies. That's all. Thank you for watching the video.